Hello and welcome to this session. In this session, you will now learn about stock prices and corporate actions. So let's start with stock prices. During an IPO, an investment bank or lead manager evaluates the company's current and projected performance and health to determine the value of the IPO for the business. Generally, this is done by comparing the company with the IPO of another similar company, or by calculating the net present value of the firm. The company and the investment bank will meet with the investors to help determine the best IPO quantity and price. Let's say, for example, a company whose value is estimated at 100 crore rupees may want to issue 10 crore shares at 10 rupees each per share, or they may want to issue 20 crore shares at 5 rupees a share. Now let's look at the fluctuations in stock prices. Just like any other product, the price of equity shares also fluctuates due to demand and supply conditions. The factors that contribute to stock prices include market forces like market news, either positive or negative, price momentum in international markets, price change in similar stocks of same industry, and lastly, even the earnings of the company plays a major role in determining the price of its shares. If a company's results are better than expected, the price jumps up. If a company's results are worse than expected, then the price will fall. Speculative activities undertaken by the traders could also impact prices adversely. Now coming to corporate actions. Corporate action is any event that brings material change to a company and affects its stakeholders. This includes shareholders, both common and preferred, as well as bondholders. These events are generally approved by the company's board of directors. Shareholders are permitted to vote on some events as well. When a publicly traded company issues a corporate action, it is initiating a process that will bring actual change to its stock. By understanding these different types of processes and their effects, an investor can have a clearer picture of what a corporate action indicates about a company's financial affairs and how that action will influence the company's share price and performance. Splits, dividends, bonuses, mergers, acquisitions, and spin-offs are all examples of corporate actions. Bondholders are also subject to the effects of corporate actions, which might include calls or the issuance of new debt. Moving on. Stock split is a technique through which the number of shares of a listed company is increased without changing the total outstanding shares in the market. A stock split or stock divide increases the number of shares in a public company. The price is adjusted such as the before and after market capitalization of the company remains the same and dilution does not occur. It simply increases the number of shares in the hands of existing shareholders. So how do stock splits work? Take, for example, a company with 100 shares of stock priced at rupees 50 per share. The market capitalization is 100 into 50 rupees, which comes to 5,000 rupees. The company splits its stock 2 for 1. There are now 200 shares of stock and each shareholder holds twice as many shares. The price of each share is adjusted to 25 rupees and the market capitalization is 200 into 25 rupees, which comes to 5,000 rupees, the same as before the split. Now the ratios of 2 for 1, 3 for 1 and 3 for 2 splits are the most common, but any ratio is possible. Splits of 4 for 3, 5 for 2 and 5 for 4 are used, though less frequently. Investors will sometimes receive cash payments in lieu of fractional shares. The primary motive is to make shares seem more affordable to small investors, even though the underlying value of the company has not changed. Now let's look at some stock splits in India. Starting with 𝒂𝒏𝒂𝒏𝒕, a listed company. The average share price of this stock was rupees 1039 before the split on 22nd of July 2005. Post split on 25th July 2005, it was traded at 504 rupees. However, market capitalization didn't change much post split. Bharti Airtel split its stock face value from 10 rupees to 5 rupees with a ratio of 2:1. So the market price changed from 800 rupees to 400 rupees post split. On the other hand, a reverse stock split is the opposite of conventional stock split. In a reverse stock split, the number of shares are reduced and the face value of the stock is increased. However, the market capitalization still remains the same. A reverse stock split is also known as a stock consolidation or share rollback. For example, if before the split a company had 10,000 shares of 50 cents each. After the split, the company will have 5,000 shares at $1 each. The reverse split does not add or reduce any real value to the company. Reverse split may well come under renewed selling pressure, since now the share becomes dearer. Also, there can be pressure from exchanges, as they generally specify a minimum bid price for a stock to be listed. If the stock falls below this bid price, it risks being delisted. The limited liquidity may also widen the bid-ask spread, which in turn deters trading and short selling. The ratios associated with reverse splits are typically higher than those for forward splits, like 1 for 10, 1 for 50, or even 1 for 100. Let's illustrate the concept with a real life example. In 2011, Citigroup had launched a reverse stock split at a ratio of 1 for 10 shares. Citi's stock price had slipped to $4.5 in April 2011. Many large investors don't prefer stocks trading below $4. In order to avoid such sentiments, Citi had taken a decision of reverse split. The number of outstanding shares were reduced from 29 billion to approximately 2.9 billion. Let us look at few of the important dates in stock split. Split record date. The date on which the shareholders who own the stock will be eligible for the split. Split pay date. This is the date that the stock dividend or split will be paid. Split execution date. It will always be the first trading day following the split pay date. On this date, the stock price will be adjusted and you should see the additional shares in your brokerage account. Moving forward, in buyback, the issuing company repurchases the outstanding shares from the market, thereby reducing the liquidity of the stock. It is a management strategy to either increase the value of shares or to eliminate any threats by shareholders who may be looking for a controlling stake. Coming to features of buybacks. Buybacks increase the proportion of shares a company owns. Generally, shares are bought within a certain time frame and at a premium to the current market price. A company may buy back its shares without shareholders' resolution to the extent of 10% of its paid up equity capital and reserves at any point of time. Let's illustrate it with an example of the tech giant Apple. It was observed in the last quarter of 2013 that Apple stock had slipped below market sentiments. CEO Tim Cook noted the drop and spurred the buyback. The company took a bold step and went ahead with the buyback. Apple purchased shares worth $14 billion in a period of 2 weeks in January 2014. Now that we have covered buyback, let's take a look at bonus shares. Bonus shares are distributed to existing shareholders based on the number of shares they hold, but without changing the total market capitalization. These new shares are distributed at no additional cost. These are the company's accumulated earnings, which are not given out in the form of dividends but are converted into free shares. Companies issue bonus shares to encourage retail participation by increasing their equity base. When the price per share of a company is high, it becomes difficult for new investors to buy shares of that particular company. An increase in the number of shares reduces the price per share, but the overall capital remains the same even if bonus shares are declared. A bonus share issue is similar to a stock split in many ways. The number of shares a person holds increases while the price falls in tandem. The difference between a bonus issue and a stock split is that while a stock split usually also splits the company's authorized share capital, the distribution of bonus shares only changes its issued share capital. Coming to tax benefits, unlike dividend payments which are taxable, bonus issues are tax-free, which increase future income and offer better psychological value. Every share has a face value. It could be 1 rupee, 5 rupees or 10 rupees. In a stock split, the face value of the share falls. So if your shares had a face value of 10 rupees before a 1:1 stock split, you would now have 2 shares with a face value of 5 rupees each. This is not so in a bonus stock issue. Shareholders will hold 2 shares with a face value of 10 rupees. Bonus shares are issued instead of a dividend. Bonus issues may also result in higher dividends for investors. For instance, if Infosys gives 30 rupees per share dividend next year, investors who hold this stock will get 60 rupees because of the bonus they got this year. For the last quarter of 2013, Infosys reported reserves of 46,689 crores as of September 30th, 2014, which is why it decided to issue bonus shares at a ratio of 1:1. Moving on, the important dates for corporate action are as follows. Record date. It is the date when the investor must own shares in order to be eligible to participate in corporate events. The date decided by the company to determine the shareholders who are entitled to receive the bonus shares. After the announcement of the bonus, but before the record date, the shares are referred to as cum bonus. After the record date, when the bonus has been given effect, the shares become ex bonus. Now, ex bonus date. It occurs after the record date. It is the date on which the share price is adjusted on stock exchanges according to the bonus ratio. And the payout date? Payout date is the date on which the stated corporate action is made effective. Moving on, we'll take a look at dividends. It is the distribution of profits by the issuer to its shareholders. This distribution is possible only when the company makes surplus profits available after all its payments are made. Dividend can be in the form of cash dividend or stocks. A dividend is allocated as a fixed amount per share, with shareholders receiving a dividend in proportion to their shareholding. In India, companies declaring or distributing dividend are required to pay a corporate dividend tax in addition to the tax levied on their income. Dividend received is exempted in the hands of the shareholders. Companies paying attractive dividend rates are always favorites in the market. It is the only way of income for shareholders apart from the capital appreciation through share price. We'll now see the important dates with regards to dividends. Declaration date, the date on which the board of directors announce the payment of dividend. Record date, the date on which the company determines the shareholders who are eligible for dividend payment. In dividend date, it occurs just one day before the record date. Existing holders of the stock and anyone who buys it on this day will receive the dividend, whereas any holders selling the stock lose their right to the dividend. After this date, the stock becomes ex-dividend. Book closure date. This is the date on which the company temporarily closes its books for fresh transfer of stocks. And finally, you have the payment date, the date when the dividend is paid or credited into shareholders' accounts. On the screen is an example of dividends declared by various companies. The respective announcement dates, ex-dividend dates, and the percentage of dividend declared. You have now reached the end of this session. Thank you for your time.